Hello, viewers. You are welcome to my channel once again. My name is Sunday. How have you been doing as regards to our trading? All right. This week is almost done, and I hope we've been up and doing. All right. Without wasting much time, the normal norm is if you have come across my video, please, after you have watched my video, please do subscribe. All right. If you uh, find it interesting, if you find the video helpful, please do share it so that another person can watch it and gain knowledge from it. Don't forget to hit the like button, drop a comment at the comment section. All right. Without wasting time, today I'm going to be diving into the topic I titled Risk Management. Risk management is very, very important in trading. All right. What is risk management? Risk management involves you identifying, assessing, and controlling the potential risk associated with trading foreign currencies. All right. For you to be able to identify, to assess, and to be able to control the potential risk that is associating with trading foreign currencies, you need to apply what we call risk management. All right, it's very, very important to know how to manage risk. All right. In any business you do, don't forget trading is a skill set. It's a business. We have to take it seriously. So we should know how to manage our risk. All right. Now, these are the key aspects of how to manage risk. We have position sizing. All right. By now, we should be familiar with what we call position. You know, position sizing. This determines the amount of capital to risk on a single trade. All right. Position sizing determines the amount of capital to risk on a single trade. All right. A common ratio is 1 is to 3, meaning you risk $1, for example, depending on your currency, you risk 1 to potentially gain 3. All right. If you are risking any capital, you are saying, okay, I'm risking 1 to gain 3. I'm risking 1 to gain 2. But the minimum you should go when you are doing a position sizing, when you want to take a trade, is 1 is to 1, not less than that. Please. Very important. The next point is stop loss order. All right. Set a predetermined point to exit a trade to prevent further losses. All right. Stop loss order helps you to predetermine points to exit. It will help you to know, to help you to set an order, all right, at a point where you want to exit a trade to prevent further losses. Let's say, for example, you have done your analysis and you trust your strategy and your analysis that you have done. But the forces of the market, because we don't control the market, the bigger boys, the banks, the financial bodies, they control the market. They can determine where the market will go because they have this capital. So, in case that happens, that where your directional buyers fail at some point, stop loss order will help you to prevent further loss. Meaning that once you set it, should the trade go against you, once it gets to that level where you put your stop loss order, your trade will close. That is one good thing about trading for financial market that I like. At the point of entry, you already set your stop loss order. In case my analysis is wrong, take me out of this trade. That's very, very simple. As you place your entry, you put your stop loss order. That is one beauty about Forex. You know, it's very, very easy and straightforward. Then the next point is leverage management. You have to know how to manage your leverage. All right. Leverage, that is using leverage wisely to amplify gains without exposing yourself to excessive risk. All right. What does leverage simply do? Let's say, for example, because we they are not financially buoyant, we are not like financial institution because we are an individual traders, we are speculators in the forex market. What happens is that there's what we call leverage. That is another topic on its own. There's what we call leverage. All right. Now, that leverage simply means I don't have the capital to trade financial, to be in financial market. But what your broker will do is that your broker will put certain amount out of 100%, you only bring 10%, your broker will add the 90% for you to be able to take position in the market. Let's say, for example, you want to open a mini lot. All right, when you're talking about lot sizes, you have a $1,000 account. That $1,000 account, all you need to deposit into your own account is just $100 for you to be able to have a position for you to be able to have an account of $1,000. So you will put $100, your broker will put the remaining $900, making $1,000 in your account. So what that does is that you now have $1,000 account. But because you have $1,000 account does not mean you should be placing trade anyhow. So that is where leverage management comes in. You should be able to leverage wisely to amplify gains, all right, without exposing yourself to excessive risk. It's very important. Then, once you have put in place risk management, there's another thing we call trade management. Trade management is the strategic handling of trades to optimize outcomes. All right. Now, how do you do that? Because after you have placed your trade, you need to be able to manage your trade as the trade goes in your favor or against you. These are the key components. Setting stop loss levels that will predetermine the price at which a trade will be closed to prevent further losses. Now, once you set your stop loss level, that is a price. Now you are saying once the trade goes against me, if I'm ready to lose $10, once $10 is reached, take me out of the close my trade. Very beautiful and simple. That means before you even place a trade, you have already determined the amount you are willing to lose should your analysis goes wrong. The next point is adjusting position size by modifying the amount of capital allocated to a trade based on market condition. All right, trailing stops. Moving the stop loss level in the direction of a profitable trade to lock in gains. All right, I will show us in a moment. Now, when you want to trail using a trail stop, for example, you you enter from here. Let's say, for example, you enter from here, you enter a trade from here, all right, and you see that your analysis is right, all right, and you'll be making profit. Price got to this place, it make a little retracement, and it's still going down. So what you need to do, all right, all you need to do is move your stop loss up to this point. Let's say, for example, let me quickly show us so that let's say you enter like this. This is where you put always above structure. This was your entry point, for example. I'm just using this as an example. This reddish color signifies stop loss. Then this is your profit side. Let's say, for example, this is your trade. You are in this trade. This place is where this is your entry. From this place back to the upside is if you see price going this direction after you have done your analysis and you are saying that the trend should be bearish. That means you are doing sell to buy. All right. So at some point, you now see that price is coming down and is going to your favor. All you need to do is move and tighten your stop loss. All right. You can even tighten your stop loss, keep on adjusting your stop loss. You can even move your stop loss into profit. All right. That means you are not losing anything. All right. None of your capital is at risk at this point since you have moved your stop loss into profit. That means as the trade is going, you're only making profit. All right. Apart from that, you can just be adjusting it gradually. All right. You can be adjusting it gradually. From there, you move it here. You have adjusted it. You move again. You have adjusted it. As the trade keep going, you keep tightening your stop loss. All right. So that is it. It's very simple, guys. Adjusting position size. That is modifying the amount of capital allocated to a trade on market condition. Then trailing stop. Moving the stop loss level in the direction of profitable trade to lock in gain as I've just showed us now. Then scaling in and out. Then what does that do? Gradually increasing or decreasing the size of a position to manage risk and maximize profit. Just like as I've showed us, gradually you are reducing the amount you have already placed as a stop loss. All right, you are tightening it as the trade is moving to your favor. You are tightening it. Then the next point is monitoring market condition, because what most people do is that they will just place a trade and just leave it without proper trade management. All right, as the trade is going to your favor, tighten your stop loss. It's very important. Monitoring market condition. Continuously observing market trends and indicators to make informed decisions is very, very important. Monitor market condition as you are on a trade. All right. Most importantly, effective trade management helps traders maximize gains, minimize losses, and manage risk throughout the trade. So, guys, is very, very important. All right. This is the end of this topic. Please do subscribe to my channel, like and share my video. All right. This is my YouTube channel, www.youtube.com/@againstfx. All right. Thank you so very much. And let me practically show us uh, some examples so that we will understand what I am saying uh, just now. Let's say, for example, I am going long, all right? I entered from here, all right? Like as I've showed us, I entered from here. I am saying I want to buy to sell. Then I put my stop loss here, all right? Below structure, very, very important, below structure. Then this is my entry, this is my stop loss. All right. Now, when you look at this place, this is almost, uh, you see, 1 to 3. All right, almost 1 to 3. You can even stress it to make it complete 1 to 3. All right, to make it 1 to 3. But the only for teaching sake, what you will do here is that as the trade is going your direction, all right, then you start to tighten your stop loss. Your stop loss was here before, about 28 pips, for example, 28.7 pips. Now because you are already in profit, and you know that your analysis is right, you are already in profit, you tighten your stop loss. You can even move it, you see, you're not losing anything. Even if you just go and sleep, at the end of the day, if it did not hit your target, this is your take profit level. If price did not hit your take profit level and it rolls back, what happens is that once it gets here, you are not losing anything. All right? You just break even. All right? That is how it is, guys. And one thing I want us to understand is that as you open your chart, please use what you need. First thing you need to do is mark the high and mark the low and the high so that you know you mark the high and the low. Then check to know where you are in the market. If price action is in a push phase, you should know that. You should figure it out. If it's in a retracement phase, please try to figure it out because those are the things that you must know before you jump into placing a trade. It's very, very key. Once you have marked your low and your highs, then know what the market is doing at that moment. If it's in a push phase, you just know that okay, it's in a push phase. If you cannot just jump into it anywhere, wait for price action to get to, if it's bullish, wait for price action to make a pullback, or if it's already at a resistant place, resistant level, wait for it to give you a direction where price wants to go next. Guys, another thing you need to do is that just work on your psychology. All right? Work on your psychology. Trust your strategy. Do a back test. It's very, very important. Back testing is the key to trading. At the end of every business day, do a back test. all right, to know what you have done wrong and what you have done right so that you can improve. Thank you so much and God